in real time, we are looking at a current chart of S&P 500. And I'm gonna space this out to a 1 year chart. And you see some lines there. This red line that you see is the 200-day moving average. And as you can see, we took this big dip in April, and we have ran up since then. Usually, the market will stay above the 200-day moving average when it comes to price. And we also have this yellow line, which I'm not sure if you see, this 75-day moving average, right? So 1 year out chart, we can see that the market was moving up, and then it had its really big dip in April, and now we are been running since then. And if we're gonna make this a little closer, so this is 6 months from April all the way up, right? And as we can see, the market's been moving up. We had a dip a little bit in early August. We moving up again. Now we are back in our possible correction levels, right? 3 months out, as you can see it from a magnifying glass standpoint. The 75-day moving average, right? It hit it right here, which was in June. We ran up. It came back down a little bit lower than that 75 in early August. We ran back up, and now we are currently testing those levels again. Going 1 month out, a little bit of a closer magnifying glass. And every time you get closer, you start to see price movements. You start to see levels, and you start to see where the support and resistance levels are when it comes to technical analysis. And I'm not trying to be, I'm not trying to teach technicals right now. I'm only making the visibility of the stock market and how price matters and what these levels mean. It's very important that you understand when you are investing how seasonal markets move, catalysts when it comes to the stock market, interest rates, the Fed, all of it is important. Because obviously, I'm looking at a bunch of red over the last week. And this actually started when we got the PPI report, which basically said that we have hotter inflation in the month of July, and tariffs could be impacting inflation in a negative way, meaning higher inflation that has been manifesting through the market, through businesses, and ultimately to the consumer. And we may see more inflation. Again, if you go back to the Fed mandate is to get inflation to 2%. If we continue to see hotter inflation data, the market will not react positively because the market is assuming that we're going to get a rate cut in September.